Dividend-paying stocks are stocks that provide a regular stream of income to their owners. You can usually trade these kinds of stocks with a focus on dividends or appreciation in value, although the best ones often do both. But not all dividend stocks are great investments, so it's important to know what you're looking for when you do your search. To make it easier, here are a few dividend-paying stocks that might interest you. The list of dividend aristocrats is a great place to find some dependable stocks. These are companies that are both in the S&P 500 index and have paid and raised their dividends for at least 25 years. But before we dive in, remember, nothing you see in this video is financial advice. These videos are intended for educational purposes only. Please always make sure to do your own research and consult with a licensed professional before making any investments or financial decisions. You can find all useful links in the description box below. 1. Ecolab, ticker symbol ECL. Ecolab specializes in a lot of different sanitizing, cleaning, and water treatments for customers. They help people in all different industries maintain clean environments and get the most out of their energy use. It serves a lot of customers from all over the world, almost 10 million of them. One of the best dividend aristocrats to invest in is Ecolab because they offer leading technology, strong customer relationships, and continued growth opportunities. They have 25,000 employees with work sites spanning around the world. They visit customer sites to replenish their consumable products, accounting for roughly 90% of the company's revenue, and cross-sell other services from their service range. They have a target market size of around $100 billion, and customers are spending roughly $6 in addressable products for every dollar they spend on Ecolab's business. As the company has done so far, they will keep taking an increasing share of the market and deepen customer relationships in the years to come. Although it doesn't offer the highest dividend yield, Ecolab's dividends increased 14% a year over the last decade and 17% a year over the last 3 years. Macro headwinds are impacting this business growth, so they raised the dividend by 5% earlier this year. However, we still expect them to continue to grow their dividends in the long run. From both a financial and a dividend sense, Ecolab is in great shape. They have a low payout ratio and high free cash flow generation, which will allow them to continue promising dividend growths. ECL stock yield is 1.3%, it's trading at 24.7 times forward earnings estimates, and it has a potential of 15% annual earnings growth. Given the company's current situation, this would make it one of the fastest growing dividend stocks on the market right now. 2. Johnson & Johnson, ticker symbol J&J. Johnson & Johnson is one of the stocks in this conservative retirees dividend portfolio. It's one of the largest, most diversified healthcare companies in the world. Johnson & Johnson doesn't just make drugs. It also has a consumer and medical devices business which generates over half of the company's total profits. That way you don't have to worry about drug prices as much bouncing up and down every time petroleum prices fluctuate. J&J generates a little more than half of its sales in international markets, which will likely see higher spending on healthcare over the next 10 years and beyond. Over $8 billion each year is spent on research and development, so it's no surprise they have such a good success rate with new drugs. The company's more consumer-focused and medical devices allow it to have consistent cash flow and reliable investments. Management is also only investing in markets they know they can dominate. Johnson & Johnson has 70% of their revenue coming in mainly from products that come first or second in the market. Over the last decade, the company's dividend growth rate has been 8.8%, and over the last 3 years, it has been 7.1%. With over $37 billion in cash and $14 billion in debt and an acceptable payout ratio, Johnson & Johnson wouldn't have to cut its dividend no matter what. 3. Procter & Gamble, ticker symbol PG. Procter & Gamble is one of the safest dividend aristocrats. They have a long track record and are selling brands you'll recognize. Their products include Pampers, Tide, and Head & Shoulders. More than 20 of Procter & Gamble's brands have annual sales of at least $1 billion and are sold in over 180 countries worldwide. With $8.4 billion past advertising spend, the company can maintain a strong market share and be at the forefront of consumers' minds when they go to buy something. In response to years of sluggish growth, the company is slimming down by dropping 15% of underperforming brands. Procter & Gamble expects to return up to $70 billion in dividends and stock buybacks over the next several years. Procter & Gamble have grown its dividend around 10% per year for the last decade, but this has slowed down to about 7% over the past 3 years. The dividend is expected to grow, but only slowly. The company will be balancing its brand portfolio, so it may take a while before the company has sustainable earnings. As long as you don't expect those dividends to rise too quickly in the meantime, though, PG stock should do okay. 4. PepsiCo, ticker symbol PEP. PepsiCo has some of the world's most famous brands, including Pepsi Cola, Gatorade, Frito-Lay, Quaker, and Tropicana. This company's 22 largest brands each generate at least $1 billion in sales annually. Over half of their revenue comes from the North American region, and they split business evenly between bottled water and food snacks. PepsiCo's main advantages are its well-known brands and distribution channels. The company spent $35 billion last year on promotion to maintain its shelf space, display products in stores, and distribute items to keep it at the front of shelves. PepsiCo's snack and drink products make it a one-stop shop for many retailers. In North America, PepsiCo is almost twice as big as its next largest competitor, making it an attractive vendor. The company's average growth has been about 9% in recent years and is compounded every year by 10.6%. The payout ratio is 50%, which should allow plenty of room for future dividends. PEP has a dividend yield of 2.8%. Basically, this means that you get an extra payout from the company, and it also tells you how much is expected to be paid out in dividends every year. Its current valuation, or market price, is 21.7 times its best guess at what a stock's earnings would be for the next 12 months if things continued. The company's free cash flow per share has grown by 11% per year over the last 5 years, which we believe is sustainable. We anticipate at least 6% to 8% profit growth on top of that, which should translate to a total return of 9% to 11% in the long run. 5. Walmart stores, ticker symbol WMT. The world's largest retailer isn't giving in to Amazon, even as they take up more and more of the retail pie. Walmart launched some pretty aggressive moves in 2016, spending over $3 billion to buy Jet.com, a popular e-commerce company. Walmart is taking jabs at Amazon by now offering free 2-day shipping on 2 million plus items, no membership fee needed. Amazon charges $99 for a Prime membership, which includes free 2-day shipping and other perks. Walmart has increased its dividend every year since 1974. 6. Target, ticker symbol TGT. Target has a history of outperforming its competition on every level, from gross margins to operating margins. They continue to prove that they can hold their own without resorting to price wars or risky discounting. The company has kept sales and profitability growing at a respectable rate by concentrating on building its e-commerce operation and extending its in-store products. With 50 years of dividend growth under its belt, Target should be on the shopping list of dividend investors. 7. Coca-Cola, symbol CO. Coca-Cola has a long history of satisfying consumer thirst, but it also works wonders for investors' hunger for profit. Since 1920, the business has increased its quarterly dividend every year, for a total of 54 years. According to market data, the demand for carbonated drinks has been declining in the United States for more than a decade. In order to maintain its revenue stream, Coca-Cola has responded by expanding its product line to include bottled water, fruit juices, and teas. 8. Genuine Parts, ticker symbol GPC. One of the biggest distributors of office supplies and electrical components, in addition to vehicle and industrial replacement parts, is Genuine Parts. The business, which was established in 1928, primarily operates in the United States 82% of sales and Canada 10%. The company runs its automotive business under the well-known Napa brand, which accounts for just over half of overall revenue. Genuine Parts has a number of competitive advantages, most of which are founded on practicality. For instance, Genuine Parts can supply products around the clock and has the largest auto parts network in the nation. Due to the company's scale, it can also store nearly $3 billion worth of goods, providing customers with the widest range of options. Genuine Parts has a market share of less than 8% in the $170 billion auto and industrial industries combined, which leaves plenty of possibility for development as the company continues on its path of consolidation. Genuine Parts has increased its dividend for more than 50 years in a row, making it eligible to be included on the list of dividend kings. Because of the company's 53% payout ratio and the consistent expansion of the company's cash flow as a result of the aftermarket business, management has consistently increased the dividend of the company by about 7% per year for more than 10 years and expects this growth to continue. GPC is a stock that currently offers a 2.9% dividend yield and trades at 19.8 times forward earnings estimates. Management believes the company can grow its earnings by 7% to 10% per year, which would result in total return potential of 10% to 13% per year. 9. Lowe's, ticker symbol LO. It might not appear to be an exciting stock to buy the home improvement juggernaut. And unless you like dividend growth, that is accurate. Since coming public in 1961, the company has increased its dividend every year. In the last 10 years alone, the payout has increased by a staggering 471%. Another significant figure that favors Lowe's is, the typical American house is 37 years old. The upcoming DIY generation will shell out a lot of cash at Lowe's. 10. Walgreens Boots Alliance, ticker symbol WBA. Walgreens, one of the biggest retailers of pharmacies worldwide, is going through a significant transformation. As a result of its measures, prices have already been reduced, digital sales have increased, and perhaps most significantly, full-service healthcare clinics have been added to hundreds of its retail sites. This prosperous business is becoming more of an integrated healthcare organization, which is boosting its already generous dividend to even higher levels. There is a lot to like about Walgreens stock for dividend investors, including a dividend yield that is currently well above 4.5% and 6 decades of annual payout growth. 11. AT&T ticker symbol T. Dividend payments are linked with telecommunications stocks. Customers pay for service on a monthly basis, guaranteeing a consistent flow of funds to pay dividends. For over 3 decades, AT&T has increased its dividend each year. Additionally, it has one of the highest dividend yields in the S&P 500 as a whole. 12. Cisco Systems, ticker symbol CSCO. Not only did Cisco just report fiscal Q4 earnings that were higher than anticipated, but it also offered upbeat fiscal 2023 projections. Remaining performance obligations for CSCO are more than $31 billion. Nearly a third of its revenue comes from that. Cisco will find a ton of new business in the interim. Cisco is still making the transition from a hardware-centric to a subscription-based revenue model. The stock of the IT company may not appear to be performing well right away. Its free cash flow generation, however, contradicts that. If you're a dividend investor who prefers to purchase and hold stocks, Cisco should be at the top of your list. There's a good chance you're looking for a large dividend payout to generate income today or capital to reinvest to increase your wealth. Here are some ideas to help you maximize the amount of dividends you earn. First, consider dividend yield rather than dividend size. The dividend yield, or the percentage of the share price paid in dividends per year, is more important than the dividend amount per share. Next, don't prioritize owning high dividend-yielding stocks. Priority should be given to business quality and a company's ability to maintain, and even increase, payout. Only then can you determine whether a high dividend yield is sustainable. If you've got any other dividend stocks that you feel should have been mentioned in this video, feel free to let us know down below in the comments section and why you feel they deserve a spot.